You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
Welcome. You are listening to, watching the Financial Survival Network. Well, when will the Fed capitulate? When will they have to give in and change course? Is it next week? Is it the month after? Or perhaps the end of the year? Well, Michael Pento, you find him at pentoport.com, is with us now to give us some insight into the Fed's next move. Michael, great to have you back. So is the Fed willing to stand idly by while the global financial system implodes?
Well, it's always great to be with you, Kerry. I love our conversation. So yeah, I mean, I wouldn't listen to CNBS to let you know when the Fed's going to turn around, because every day is a reason to be bullish there. I mean, the same people who told you that everything was fine in January are now calling a bottom. For one particular gentleman, Jim Cramer, he gives you the bottom several thousand points ago, by the way, several thousand Dow points ago. And his reasons are inane. He tells you that the market's bottoming because Apple is run by Tim Cook, who's a great guy. and the company isn't going away. Is that what we're doing here? That's just charade. Yeah. Apple is a great company, agreed. Tim Cook might be a great manager, agreed. Apple's not going away in anybody's prognostication out in the future. But at what price are you willing to pay for Apple? Okay, you can't tell me that the market is trading at 16 times next year's earnings because you have no idea what those earnings are. Don't tell me what your forward PE ratio is. Because, by the way, the trailing PE ratio right now is almost 20, if you want to do the correct math, okay? That's a very rich 19.3 or something like that. It's very rich valuation for a U.S. economy and a global economy that is rapidly slowing. I mean, they actually come up, I have people come on these mainstream financial media channels and tell you that the economy is white hot, and in their purview, they can't see anything slowing in the economy. No signs of a slowdown. Well, how about the negative GDP print that we just had for Q1? How about the Empire State Manufacturing Survey, which is negative on the diffusion index, negative 11. So, listen, the market's going to bottom when the Fed changes their mind and stops trying to fight inflation. Well, what would cause that to happen, Kerry? I'm glad you asked. Inflation right now on a second derivative basis came down from 8.5, 8.7 to 8.3. Big deal. It's still over 4 times where they want it to be. The Fed has an inflation problem. They know that the economy cannot function well. A healthy economy cannot function properly with an inflation rate at over 8%, the way the government measures it. So Powell is forced, whether he wants to or not, even the administration, even the Biden administration is standing over him saying, hey, we need to get inflation down. Otherwise, we're going to get slaughtered in the midterms, which are probably going to happen anyway. But listen, the Fed will fight inflation until inflation is anywhere between 4 and 5%. Otherwise, it's just full foot on the brake on the economy until that happens. Two exceptions. Number 1, 2 negative back-to-back non-farm payroll reports. That'll get the Fed's attention. Or, more importantly, a complete freeze of the frozen credit markets, where the repo market freezes, you can't issue any new junk bonds, corporate debt completely seizes up, commercial paper can't be floated. That will force the Fed to stop. But I will tell you this, as I said to you in the pre-interview, between that freezing of credit markets and when the Fed is able to reliquify the market, you're probably looking at several lock limit circuit breaker days down in the S&P 500. You don't want to be long especially levered long, Kathy Wood in that environment.
Hey, bring up a great point. I think we might have a new meltdown indicator, and that is the repo market seizure. Everybody's forgotten it now, Michael, until the next time. And right, credit freeze up is just a matter of time here, isn't it?
Well, if you look at, I look at LIBOR, OIS spreads, I look at high yield spreads, junk bonds to treasuries. I look at all those things, part of my 20-point model. They're flashing bright yellow or maybe a soft red, a soft orange, red, where you pick the color. It's not green. It isn't any shade of green, Kerry.
Mm-hmm.
It's not Kelly green, Kerry green, or anything like that. It is very close to saying, get out because the credit markets are about to shut down. I don't know if that's days, weeks away. I don't know. I don't have that knowledge. But if you look at these spreads, they're telling you that something is fundamentally wrong in the financial system. Banking system is ready to freeze. And like I said, I don't know if it's days, weeks, or maybe it is as late as the fall. I don't know. I mean, my model will tell me when it happened, and I'm already very defensive in the portfolio, as you know. But it's going to be too late if you're not already hedged for such an occurrence. They do have that standing repo facility, but that standing repo facility is for treasuries. It's not for junk bonds. It's not for commercial paper. So you're going to have a big problem in the credit markets, which is, the nexus between the credit markets and the stock market are inexorable. I mean, they're inextricable. It's a better word. They're tied as like Siamese twins. And when the credit markets break, watch out. And they're already fracturing as we speak.
Hey, well, I'd say it's probably flashing bright orange. I got stopped for running a traffic light by a cop one time, and he said, "You went through a red light." I said, "No, I didn't. It was bright orange." So he laughed and let me go. But Powell's not going to get off that easy, is he?
No. And I have to say, I'm a little disappointed in this nation. We seem to be a nation. We used to be a nation that rewarded success. They call it a meritocracy. So we have a person who was in charge of primarily in a primary function. His job was to give Americans price stability, a stable dollar, purchasing power wise. Not talking about the dollar versus the euro or the pound or the yen. Stable purchasing power. The man takes that job, brings inflation from somewhere below 2% to very close to double digits. And what happens? He gets renominated and reappointed by the Senate. So renominated by the president, reappointed by the Senate. You get rewarded for supplying Americans with the highest rate of inflation ever, and you get another tenure at your job. So we're not rewarding failure in this country instead of punishing it. Very disappointing.
Well, isn't that what every election's about?
Well, you said that tongue in cheek, but yeah, I mean, it looks to me like it seems to me like the more incompetent and feckless you are, the more likely you are to become a career politician.
Yeah, Pied Piper leading the nation off a cliff. Michael, what effects are you seeing from the Ukraine war? How much do you have a guess how much longer that's going to go on?
Well, like I said in the last interview I was on, Putin doesn't check with me before he invades.
Oh, he should.
He didn't check with me as far as Finland and Sweden are concerned either. These countries are vying to be part of NATO, and I'm quite sure that Putin is not happy about that. So the odds of Putin saying, I'm packing my bags and leaving Ukraine, and then allowing NATO to, annex, or probably not the great way to put it, but allow the other Baltic nations to become part of NATO. He's not going to happen. NATO was formed after World War II to block the advance of Russia. This is why Putin thinks it's such a bad idea to have the constant expansion of NATO. Well, now it's gotten way beyond the initial few nations that were part of NATO, and now we're talking about these Sweden. It's just not something he's gonna. It's an untenable position. He cannot allow that to happen. So what you're going to have is a protracted war in Ukraine. I don't know if he would do anything preemptive in Finland. I just don't know, but it wouldn't shock me if he did something there before they were accepted into NATO. But the bottom line is, I mean, the breadbasket of the world is being dissolved, and there's going to be food shortages and hunger. God, I mean, I hate to say it, but the world is going to be starving. Many parts of this world are going to be starving of what's happening with Russia. It doesn't look like it's going to go away anytime soon. And that has also, even if you say, well, Michael, I went to, Publix today, and the bread aisle was packed full of loaves of bread for me to choose. That's wonderful for us Americans, but the price of wheat is absolutely soaring. You saw India now cutting off their wheat exports today. So food, what I'm trying to say is food costs are continuing to be very, very high. Energy costs will continue to be very high. I don't see any let up yet in home prices. It's on the cusp, but it's coming, but not yet. So if you take, shelter costs and energy costs and food costs, and you say those aren't going to come down anytime soon, at least the rate of change, then you have a big problem with inflation, and it's not going to go away in the June reading. Not going to happen.
Well, my theory is that Wall Street runs the world, and when Wall Street starts feeling pain, then there's going to be impetus to end this war, because the U.S. is at least 50% responsible for this, perhaps more. Whether Putin's a good guy or not, well, we all know.
He's a horrible guy. Yeah. But why do we need to expand NATO? We don't think we exacerbate the situation when we're trying to expand NATO to countries that, really, do they really belong in the North Atlantic Treaty Organization?
I'm not sending my kids to go defend Sweden. Sorry, ain't happening. They were orphan. They were all neutral. I guess Finland wasn't, but all the other countries there were neutral during World War II. I mean, it worked okay for them. They should just stay neutral.
Yeah.
And not try to get a dig in on them. But in the end, money is what drives the world, and money is what Wall Street's all about. So at some point, if they start feeling a lot of pain and they think that ending the war is going to end that pain and the money will flow again, somehow, some way, this thing's going to be settled.
Yeah, but the question is when, Kerry? I mean, if your thesis is I'm going to buy stocks today because I hope that the war in Ukraine is going to go away anytime soon.
No.
It's a horrible bet. I mean, you have a lot of things that are happening in the economy that just tell me you should still be very, very defensive. And I'm not going to try to list all of them right now in this interview, but I'll just name a few. First of all, you should have this in the back of your mind. The Fed has raised rates 3 times so far. Okay, so 3 25 basis point or 125 and 50 point rate hike. That's 75 basis points of rate hikes off of 0. Okay, so the Fed funds rate, the range there is 75 beeps to 1%. That's lower than we were at any other time prior to 2003. That is the lowest Fed funds rate we have ever had. So we have a very, very low Fed funds rate. The Fed is still on course to hike rates 50 basis points in June and 50 basis points in July. All right. Then there is no August meeting, but there's an early September meeting. June 1st, he starts quantitative tightening. Now we have the average stock down 20% or more. In some cases, it's down 50% in the NASDAQ, depending on which average you're measuring. And we haven't even begun to raise interest rates above 1% or drained 1 penny from the Fed's $9 trillion balance sheet. Now, some people debate, well, how much is the quantitative tightening going to equal as far as a Fed funds rate increase? I think it's the most deflationary thing that we could possibly do is to take the liquidity out of the banking system. That's exactly what you do when you engage in quantitative tightening. It's the opposite of quantitative easing. You destroy money supply. Now, there might be a lot of excess liquidity out there right now. We can debate about how much there is. I think it's a lot less than most people think. But at $95 billion a month starting in September and starting June at $50 billion a month, that excess liquidity will be removed very quickly if there is any left. So keep that in mind. And put up a chart of the Fed's balance sheet and superimpose a chart of the S&P 500 over time. You see their correlation is very, very high. We haven't even begun really begun to raise interest rates yet. It's this incipient stage, and we haven't shed one penny of quantitative tightening. We haven't drained that balance sheet by one penny. When those two things are happening at the same time, come June, July, August, and September, I mean, you better hope, if your predicate is we better buy stocks soon because Putin's going to pack up his bags and leave. If that's your predicate, you better hope it happens very soon, because we're looking for good news. China is still on lockdown, zero COVID policy. The war in Ukraine rages on. There's food shortages all over the planet. Energy prices are still soaring. Natural gas prices are soaring even higher. If you're a first-time home buyer, you're locked out of the whole game. And the Fed is just now setting the stages in 2 weeks to step up the pace of hawkishness. So, we've had a lot of damage in the stock market. 16 times forward earnings, don't you know? Well, those earnings, sometimes the market trades at a 30 or 40 PE when the liquidity spigots are open full blast, like they did in 1999. And sometimes the market trades at 7 times a PE ratio, like it did in the 70s. So, so when you start making these calculations, well, the market is, Kerry, don't you know the market is fairly valued because on my projection of $230 a share on the S&P 500 for all of 2022, it's only trading at 16 times forward earnings. No, you got to figure, first of all, your earnings per share is wrong. It's never going to happen. And your PE ratio is wrong. It's never going to happen. You're not going to pay 19 times earnings when the market is suffering a liquidity crisis, when the credit markets freeze. You're talking about single digit PE ratio or less.
Wow. So it could come down quite a bit further to go. So our bellwether stock for this rally has really been Tesla in a lot of respects, right? Right now it's like down almost 6% today. Where does Tesla go in this scenario?
Don't just survive, thrive. The Financial Survival Network.
Fury Gold Mines is a Canada-focused exploration and development company committed to aggressively growing its scalable, high-grade gold assets with major drill campaigns planned across its 3.5 million ounce portfolio. Fury is led by a management team of proven explorers and developers with a track record of success in advancing and financing project development. Fury Gold Mines is well positioned to create value for investors with low-risk development growth and the potential for a new major discovery. Fury Gold Mines trades on the TSX and NYSE American under the ticker FURY. To learn more, go to furygoldmines.com. That's furygoldmines.com.
This is the Financial Survival Network, the information you need to thrive now more than ever.
Well, Tesla is facing a whole heck of a lot of competition. I actually for the first time in my life, I saw a Lucid Motors car. It was stop traffic gorgeous, but it's not only from the other, ancillary, marginal electric vehicle makers. Ford, GM, they're all coming out with these. They're tripping over themselves to make their entire fleet EVs as soon as possible, as quickly as possible. So they're facing a lot of challenges. I don't really comment on specific stocks, but I'll tell you, Elon Musk is a genius. He's much more smarter than I am, I'm quite sure. But how many companies can this man really run efficiently? I mean, Tesla, Twitter, he's got the boring company. I mean, really, he's really overly taxed right now, and he stars on Saturday Night Live. He makes these Saturday Night Live appearances too. He's a very busy person. So my guess is that any high beta stock is going to suffer. That's why I created my model, the inflation, deflation, economic cycle model. It told me in January, it said the rate of change of both inflation and growth will slow, especially growth in 2022, inflation later on, growth up front. And that's a really bad environment to own stocks with no earnings, stocks that have very little revenue, stocks that are like, let's just say cryptocurrencies. Or anything related to a cryptocurrency, Coinbase, anything high beta is going to suffer. And I throw Tesla in that rubric.
All right. So fortunately, your clients are actually up a little bit now. I guess sometimes by not losing, you win, right?
Well, I mean, my clients are maybe up a little bit on the, when I say up a little, I'm going to quote if I quote a return, I have to quote all of my returns because the SEC looks at every single thing you do. So I don't want to quote returns on my portfolio. If you want to see my portfolio, what it's done since the first launch of the official launch of the IDEC in 2016, you can email me and I'll be glad to supply you all of the returns for all of the years. But going off your comment, yeah, the alpha is very important here. Preserving your principal and saving your money when the average stock is down over 20% and you throw the bond market is a disaster. If you've been long bonds since the start of this year, especially duration, you've gotten wiped out. In some cases, worse than most stocks.
Yes.
So the balanced portfolio hasn't helped you. So preserving your principal, maybe, hopefully, God willing, making a little money. I mean, we haven't even entered that, what I call the 4 horsemen of the economic apocalypse. That's when you only own cash, the US dollar, shorts, and treasuries, especially short duration treasuries. We haven't even gone there. When we get there, then there should be even more alpha to the portfolio. History showed us, because if you own those 4 things, not now, but when the time is correct, you won't just lose. History shows you won't just lose less. You can actually make a whole heck of a lot of money in shorts and in treasuries and the U.S. dollar.
I'm glad you raised the U.S. dollar. Right now, the Dixie's at 104.33. I mean, this is like multi-decade highs. How high can the dollar go?
Well, when everybody asks me, what do I think about the dollar? I always say, against what? Against gold, against Bitcoin, against real estate, against energy, against what? It's a currency. So how high can the euro go? Well, against what? So if you ask me how high can the dollar go against the euro, I think the dollar can go to parity. I don't see why that couldn't happen, because I don't think Madame Lagarde, head of the ECB, is going to raise interest rates very far. I mean, she has a worse problem. Her growth problems, if you can believe it, are even worse than the United States. And we're in pretty bad shape. She has a bad inflation problem and an even worse growth problem. So I highly doubt Lagarde is going to be able to raise rates very high. So you have that interest rate differential that favors the dollar, and you have the growth differential that favors the dollar. Now, ask me what I think in a few months from now, when it becomes completely manifest that the U.S. is in a recession. That could happen sooner rather than later. I'm just saying, let's just take it to the late summer, early fall. And then you're going to get that change from Powell. You're going to get inflation fall. You probably get, on the second derivative basis, from inflation going from 8.3 to maybe 5 or 6. But what's the growth context? What does the non-farm payroll report show? If we are in a recession, but inflation falls from 8 to 6, that's not all clear signal to buy stocks. So the dollar is still long in my portfolio. I've been long the dollar before almost anybody else was. I started long positions in March of 2021. We're up double digits in that particular position in the portfolio for those who've owned it that long. It's done very well for us. Other positions haven't done well. I'm not saying that we're making double digits in every position. It's just not true. But the dollar is a buy against other currencies like the yen. Mr. Kuroda over in Japan, he says we will not allow JGBs, Japanese government bonds, to yield higher than 0.25%. We will print, and this is a quote from him, I will print unlimited amounts of money to cap that yield on 10 years duration on a JGB. Do you want to go long? How much money you want to put long the yen versus the dollar, given that scenario? Not in the short term, but that all changes once the Fed acknowledges that we are in a recession and he has to change. Then the dollar is going to get wiped out, and I plan to be out well before then.
Arguably, you could make the case that we already are in a recession, because the inflation deflator that's in the GDP numbers is grossly inadequate.
The personal consumption expenditure deflator, trim mean, substitutionalized, hedonolate. We would be in I could put it this way. I'll agree with you halfway. So a technical recession from the NBER is 2 consecutive quarters of negative growth. 2. We only had 1. But I will concede this to you. The first quarter negative print of 1.4% would have been much, if you had a real inflation metric to deflate nominal GDP, it would be much more negative. And 2, I would not rule out, based on what I saw this morning on the Empire State Manufacturing Survey, I would not rule out that Q2 could be also negative. And then you get your, and then you still hear people on TV say, Kerry, the consumer is strong, don't you know? And corporate balance sheets are flush with cash. Don't you know how wonderful everything is?
Yeah. So where does gold fit into all this?
I had been max long gold in the portfolio, which my nomenclature is 20%. So gold miners and gold. I sold all of my gold miners in the last couple of weeks. I just hold a 10% position in the portfolio in physical gold, around a 10% physical gold. I will remind you that in a liquidity crisis, gold does not behave very well. And if you think I'm wrong, just look back to 2008 and 2020. I mean, it's like, hey, I have no dollars. I need to sell whatever I can sell. And gold has been doing very well, as you know. You sell what you can. You sell what you have to reliquify your balance sheet. And gold is one of those primary things. So the shadow banking system just unloads gold. And I mean, it's going to happen again. If I'm correct that we're headed for that liquidity crisis, it'll absolutely happen again. I will remind you, look back and like I've done, how I created my model, back test what happens after that happens. After that liquidity crisis happens, you get gold on sale, and I mean on sale, deep discount, and it doesn't last long. Because if I'm correct and the Fed comes behind that liquidity crisis and says, okay, unlimited QE, Janet Yellen shakes hands with Powell and says, here comes the helicopter money, we're going to monetize all of that. Forget about a couple of trillion, we'll do tens of trillions of dollars, whatever it takes to get everything open. And gold will it'll be boom, boom, like that. So that's how I judge what to own. I look at the second derivative of policies in the G3 nations, fiscal and monetary policies. And when they change and they interface with the model, then I make the change. And I think there's a great opportunity. If you don't, if you haven't owned gold yet, if you're waiting for it, like, I don't want to spend $2,000 an ounce, I don't want to spend $1,800 an ounce. If you want to get something like, $1,400, $1,500 an ounce, because you'll get it for maybe a day, and then it'll should soar higher. Yeah.
It's like 2020, right? March 2020.
Exactly. Look how truncated that sell-off was in the pandemic, and how fast the shadow banking system sold, and the primary dealers sold what they could. One of those things was gold. They threw the price into the toilet for a very short period of time, and then when they changed to reliquify the banking system, because they have to do it, because if they don't do it, you say, well, Mr. Pento, why would they do that? Why would the Fed acquiesce to reliquify the banking system? Because we would all be starving in the street. If you can't float commercial paper, and if you can't issue any corporate bond, the economy doesn't work. It's like, go ahead, start your car, and then take out if there's still a nut that drains the oil pan. See what happens. See how well your car runs without oil. Well, the credit markets are the oil to the financial system. They will have to. They don't want to do it. They might not want to do it forever, but they have to do it, and they will.
They always have. They always will. In the end, let's not forget why the Federal Reserve was ostensibly created as the lender of last resort when the banks are going down the toilet. And we've seen it happen over and over and over again without, it seems it's happening more often now, but it's been going on for decades. So in the end, they don't exist for you and me, Michael. They exist to assure that the banks keep their doors open, because it's unacceptable to go to the ATM machine and have it reject your card, or go to a restaurant and pay for dinner and then, sorry, the credit cards aren't working. Where does that leave you?
Kerry, in 1913, it's a bad year in general for this country.
Income tax and Federal Reserve.
Yeah, we didn't have a very good president, and we didn't have the Federal Reserve Act before then. But it was a discount window. So if you were a bank in trouble, you were able to bring your assets to the discount window at a discount and get a small loan. That was ostensibly why the Federal Reserve Act was passed. I don't think, at least I hope, it wasn't in the mind of our politicians that one day the Fed would say, we need to engender a minimum 2% inflation rate. And if we don't get, 1 3/4 is no good. Economy can't function. If we don't engender a 2%, at least a 2% inflation rate, that we will print trillions of dollars per annum until we achieve it. I don't think that was, in the minds of these politicians in 1913. But of course, the Fed has they're horrible track record of sticking the landing on inflation. For about a decade, they couldn't get to 2%. All of a sudden, it wasn't 2; it was, almost 9. And to think, it just drives me crazy, Kerry, when I hear people on the financial news media saying, it's going to be it's going to be difficult, but I still think the Fed can engender a soft landing. Tell me, any time that resembled anything like today, by the way, there isn't any, but even any time that's even close to the macroeconomic conditions of today, when the Fed was able to provide the economy on a soft landing, it's just never happened. And when they talk about 1994, today's economy is nothing like it was. Nothing close to 1994. In fact, on my next commentary, I'm writing about this. Just comparing. I'm so sick of hearing how don't you know what happened in 94? The Fed took the Fed funds rate from 3.25% to 5%, and nothing wrong. Nothing. Well, 1995 wasn't a very good year, but 94 was okay. No, today's economy is nothing like. It's much more fragile. And I'm going to have all those data points next week.
All right, excellent. Well, Michael, we appreciate you coming on, sharing your view of the market, and congratulations so far on your performance to date. If you got a question for Michael, shoot me an email, kl@kerrylutz.com. Go over to his site, pentoport.com. Send him a message, and he'll let you know what the score is. And hey, sign up for our newsletter at financialsurvivalnetwork.com. Michael, we'll be talking to you again soon, no doubt.
Look forward to it, Kerry.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.